I'm going to explain in this video why traditional accounting doesn't work for small business, specifically with creative businesses and author businesses. Now, I've been a CPA for over 15 years. I was the president of our state CPA society. I love accounting more than someone reasonably should love accounting. But accounting really isn't made like traditional accounting, the way that you're supposed to do it really isn't made for very small businesses. This video could honestly have probably been one of the money mindset rambling videos, but I'm going to do it as one of our Tuesday business basics videos for two reasons. One, it does get a little bit more technical. It's not so much about mindset. It's more just about understanding how you should be tracking things in your business. And two, I've already recorded the video for this week's money mindset and I need something for tomorrow. So today's going to be a little less formal. I'm not going to have the 3 things you should know or anything like that. I'm just going to talk about how I conceptualize accounting and what it means for very small businesses. So let me back up for a second. Whenever I was the CFO of the bank that I worked at before I took my business full time, banks and big businesses all operate on numbers on a page, financial statements, metrics, KPIs, those kinds of things, ratios, the stuff that you would expect. They don't really look at how much cash do we have in the bank, because for really big businesses, the cash almost feels unlimited. They have enough. They know that. They're not running out. So what's more important for them is their scorecard, their report card. How are they doing? And they measure that based on the reports that they run. And so my job at the bank was to run those reports and present them to the board. And one of the things that we would look at on a regular basis was called return on assets. So a bank gets money from depositors, and then the bank takes that money and does things with it. It either invests it, it buys buildings, it loans it out to other people. And based on what it does with that money, it earns money. And then from those earnings, it pays all its overhead and it pays its interest expense and it pays its payroll and all those things. And the money that's left over is net income. So you take that leftover and divide it by the total amount of assets that the bank had available to invest, and that's its return on assets. And at the time that I was the CFO, a good return on assets would be like 1.01%. So I started in September and I start reporting numbers to the board. And I don't remember what the numbers were, but let's just say for funsies that it was like a 1.2, which was good. It was better than what we needed. And then the next month, good. And then the next month, good. And then December comes around and the CEO wants to pay bonuses to employees. He did it every year. He always paid Christmas or year-end bonuses. So when those bonuses got paid, that counted as an expense in the month that we paid it. And so that month's number looked terrible. And so then every month after that, when you're comparing that month to the next month, you have to say, oh yeah, but that was the month we paid bonuses. And so I asked the CEO, would you be cool if we just started accruing for bonuses throughout the year? What that means is we'll put an expense on the books to make it look like we spent this money each month, but then we'll set up a liability account showing that we owe this money to our employees, like a bonus payable. So then that expense gets kind of dripped into each month, and at the end of the year, it's already been expensed. And so if the CEO wants to pay bonuses, then the money's already been set aside for that. So it was never an issue of whether or not the money existed. The money existed to pay the bonuses, but if we didn't accrue for those bonuses throughout the year, if we didn't record that expense throughout the year, then all of a sudden our year-end numbers look trash just because we paid a year-end bonus. So how does this relate to you and anything that you do? This last year, I paid bonuses to my employees, but I had not set money aside for that. I was still able to do it and I was happy that I was, but I was not able to do as much as I would like to have done because I didn't prepare for it from the beginning of the year. So starting this year, 2026, I set up a new bank account. I called it bonuses. And now every time I run payroll, I set a little bit of money aside into that account so that by the end of the year, I'll have that cash set aside. And notice the difference. It's kind of the same thing as with the bank, but the big difference here is it's not just an accounting entry. It's not just something that goes onto a report where I can say, okay, the expense was in January instead of all the expenses being in December or November. Instead, the actual cash is being moved aside. And that's the big difference. And that's why traditional accounting doesn't work for very small business, because we don't care about what the P&L says. We don't care about what the cash flow statement says. It really doesn't matter what the metrics are. If you don't have any cash in the bank, it doesn't matter. It doesn't matter if you've accrued the expense. It doesn't matter if you have an accounting profit if you have no money. And so that all made me realize that whenever we're doing profit first and we're setting up all these bank accounts for different reasons, what we're actually doing is they're doing the same thing as what big businesses do, whenever they accrue for different expenses, when they decide to record the expense for that thing during the months and the periods that it applies to, so that they don't take a big hit on their numbers whenever they actually want to pay the thing. And you can do the same exact thing. It's just that it doesn't make sense for you to go into QuickBooks and make a journal entry recording an expense and a liability if you don't actually have the cash to pay it. Now, could you do this with like a spreadsheet without actually setting up another bank account? Yes, technically you could. You could have a spreadsheet where you say, okay, I have this pile of cash in the bank, but this much of it is set aside for taxes, and this much of it is set aside for year-end bonuses, and this much is set aside for travel or whatever you're trying to do. But I will tell you, it is way easier to move money from one cell to the next than it is to move money from one bank account to the next. So I could have a spreadsheet where I'm just saying, okay, well, I have this much money, but I'm going to allocate this much for bonuses for the end of the year. I could do that. But whenever I move that money from my OpEx account over to the bonus bank account, if I ever pull money from that bonus bank account, I feel like that's already my team's money. I feel like it's not mine anymore. And that's kind of the point. If I ever pull money from there, I'm going to feel like I'm taking it from the team. Like I'm saying, hey, I'm going to give you these bonuses, but can I borrow $5 to cover this expense over here? And I'm going to instead think of other ways to cover any shortfalls that I might have. So this whole profit first system, this whole idea of setting aside bank accounts and setting up bank accounts to set aside money for the things that you want to do, it's all about being able to make decisions when you're in decision-making mode rather than waiting until you're in panic mode, or rather than making your decisions based solely on how much money is in the bank at the time that you're making the decision, rather than making the decision ahead of time to make sure that you have the money in the bank when you're ready to. Now, let's say I got to a payroll run and I just didn't have the money to put aside for bonuses. That would tell me something. That would tell me maybe I was trying to pay more of a bonus than I could afford, or maybe I had other expenses that I really needed to analyze if it meant that I had to forego the bonus that I felt like my team deserved. You are going to notice that these videos, closer we get to tax deadline, are going to get shorter and shorter. We're going to get back to full-length feature films whenever we have more time on our hands. But what is one area where you have tried to do something with traditional accounting and it just hasn't worked for you? Or is there anything about accounting that's made you think this doesn't make sense to me? If that's the case, let me know in the comments, because I'm willing to bet it's not that you don't understand accounting. It's probably just because generally accepted accounting principles don't make sense whenever you're a small creative business. Let me know what you think, and I will see you next time.